Welcome to Financial Ratio Analysis. So financial ratio analysis is one of the analytical tools that finance managers and analysts use to measure how financially healthy a company is. So in this topic, we would like to answer some of the questions like how do financial ratios as an analytical tool help us interpret and analyze a company's financial position, which is the balance sheet, and performance, which is the income statement, including the liquidity, solvency, profitability, leverage, and market value of a firm. And also, how are these financial statements based on ratio analysis can provide as a foundation for projecting a firm's future. So ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor a firm's performance. It's not only important that you are familiar with the formulas or you memorize the formulas and you know how to compute for these formulas. It's more important that you know how to interpret the result of these ratios for you to be able to analyze and monitor a firm's performance. So, just like kapag ang isang tao may sakit, merong physical illness or disease, may mga kinakandak ng mga laboratory tests and analyses para ma-assess kung ano talaga yung sakit niya. And from there, magpe-prescribe ng gamot para sa kanya, and hindi rin natatapos doon. Once na magkaroon ng resulta, definitely kailangang i-monitor yung progress ng isang pasyente. So sometimes it takes a week, months, or even years to monitor the health of a person. So ganun din naman sa isang company. So if there are problems, so nakikita yan sa ratio analysis. For example, may kakayan ba yung company na magbayad ng utang? Nagde-default na ba siya sa payments niya? So nakikita natin sa ratios niya. Is this company profitable or not? So nakikita din sa ratios yan. So financial ratios involve the use of numerical values taken from both income statement and balance sheet. That's why it's very important for us to become familiar with the statement of operations that includes your sales revenue, so gross profit, operating profit, net income, or earnings available for common shareholders. So depende sa type of the organization and sa nature of the business, yung chart of accounts. Now, for statement of financial position, so as we all know, it's categorized into three. You have your assets, liabilities, and stockholders' equity. So yung mga numerical values or figures natin would be coming from your income statement and balance sheet. So pag-compute natin ng mga ratios. Alright, so these are the 5 major financial ratios. We have liquidity ratios, activity ratios, stability ratios, profitability ratios, and market ratios. Liquidity ratios, okay, they are also known as solvency ratios. When we say liquid, diba, we're talking about cash. So cash is king, cash flows, right? So meron bang enough na cash ang company para bayaran yung kanyang mga current obligation? Is the company liquid? Okay, is the company solvent? Madali bang i-convert yung mga current assets ng company into cash? All right, so there are 2 liquidity ratios under it. We have current ratio and we also have quick ratio. Now, activity ratios, also known as working capital ratio or efficiency analysis or efficiency ratios. It answers how efficient is the company in using its assets, okay, to generate sales for the company. It also talks about the speed. Gaano kabilis ang company na mangolekta ng kanyang mga pautang? Gaano kabilis din na magbayad naman ang company ng kanyang mga pinagkakautangan? Okay, gaano kabilis or kabagal ang company na mag-convert ng kanyang mga inventories from the time na ito ay binili as a raw material hanggang sa maging work in progress, hanggang sa maging finished goods, hanggang sa may benta siya at hanggang sa makakolekta ng pera. How many days does it take for a company to do that? And of course, the total assets turnover. Now, for stability ratios, how does it differ from liquidity ratios? Stability ratios measure the ability of a company to pay its long-term obligation. Kung ang liquidity ratio, minimeasure niya kung gaano kagaling ang isang company na magbayad ng kanyang mga current obligation. Ang stability naman, it measures yung kakayahan ng isang company na magbayad ng kanyang mga long-term obligations. Those loans and debts that are payable after a year or sometimes 5 years, 10 years, 20 years, ayan. And some of these ratios include debt ratio, debt-equity ratio, and times interest-earned ratio. Isa sa pinaka-popular na ratio is of course yung profitability ratios. As we all know, investors in a company and management, they are mainly concerned in profitability, both in the short run and long run. For creditors naman, mas after sila doon sa liquidity ratios and stability ratios because they would like to know if may kakayahan yung company na bayaran sila sa kanilang utang. Okay? Now, profitability ratios include gross profit margin, operating profit margin, net profit margin, earnings per share, return on assets, and return on equity. Whereas market ratios naman, price earnings ratio, market book ratio, dividend yield, book value per share is used, okay, in the computation of some of our market ratios, and of course, price earnings growth ratio. Liquidity ratios measure a company's ability to meet its short-term obligations. So we have two under liquidity ratios. We have current ratio and quick ratio, or also known as acid test ratio. As you notice, they have common denominators. We have current liabilities. Nagkakaiba lang sila sa numerator. For current ratio, it includes all your current assets. What are your current assets? That include your cash, marketable securities, accounts receivables, inventories, and other prepayments. Whereas for quick ratio, okay, you exclude inventory in the computation. So only cash, marketable securities, accounts receivables, and other current assets except for your inventory. The question is, why do we have to exclude inventory in the computation of ratio? And as we all know, quick ratio is a better measurement of the liquidity of a company than current ratio. Inventory is not part of the computation because inventory is the least liquid among all the current assets. Sila yung pinaka-matagal or mahirap i-convert into cash. Why? It takes time to convert raw materials into work in progress, into finished goods, right? And eventually sell them and receive cash from the sales of your goods and services. Okay, next, activity ratios. Activity ratios measure how efficiently the company is managing its assets. So it answers the question how fast or how slow the company is when it comes to managing its receivables, when it comes to collecting receivables. How fast or slow is the company when it comes to paying its obligations? How fast or slow the company is in converting its inventory into cash? And how efficient the company is in managing its total assets so as to generate sales for the company. So pag turnover, what did you notice? Kapag turnover ang hinihingi, for example, accounts receivables turnover, accounts payable turnover, inventory turnover. So kung ano yung hinihinging account, yun yung denominator. So if it's accounts receivables turnover, napansin nyo, the denominator is your accounts receivables. Saan nanggagaling yung accounts receivables? Sa net sales. That's why yung numerator mo is net sales. What about accounts payable turnover? Kaya ka nagkakaroon ng accounts payable because meron kang mga raw materials or purchases na binibili from your suppliers to produce your goods and services. Tama? So the denominator is accounts payable and your numerator is your net purchases. What about inventory turnover? So your denominator is inventory and your numerator is cost of goods sold. Because your cost of goods sold, that includes your inventory at the beginning of the year, plus any purchases, plus any freight in, and less inventory at the end of the year. So yun yung cost of goods sold mo. And of course, total assets turnover naman. Total assets is your denominator. And of course, net sales. Gaano ka-efficient yung company na gamitin yung kanyang mga total assets para mag-generate ng sales. Well, net sales means deducted na yung mga sales returns and allowances. In some books, they use average accounts receivables. Bakit? Why is it good to use average accounts receivables instead of the accounts receivables on a specific year or time period? It's because kapag average, mas na-measure mo yung totoong value ng accounts receivables. So for example, if your accounts receivable last year is 1 million pesos and then this year it's 5 million pesos, So definitely, magkakaroon ng distortion or malaking gap sa pag-compute ng accounts receivables turnover mo. Okay? But if you get the average, at least you get the nearest, okay, amount of your accounts receivables. Okay? Now, ganun din naman sa iba like accounts payable and inventory and even total assets turnover. Now, average collection period. How do we compute for average collection period? So 365 days, or depende if the given problem is 360 days, but if the problem is silent, we use 365 days divided by the result of your accounts receivables turnover. When it comes to average payment period, 365 days, your numerator, divided by the accounts payable turnover, yung result nito. And average age of your inventory, 365 days, divided by your inventory turnover, the result of this one. Okay? So pag sinabing average collection period, how many days does it take for a company to collect its accounts receivable? Okay? Gaano kabilis or kabagal mangolekta ng mga receivables ng isang company? Average payment period naman, gaano naman kabilis or kabagal ang isang company na magbayad ng kanyang mga utang. Okay, and of course, average age of inventory, gaano kabilis or kabagal na mag-convert na ang inventory into cash ang isang company. So, that's it. And the next, we have debt ratio. It talks about the amount of other people's money being used to generate profits. It's also known as leverage. It's also known as capital structure ratio. Okay, it measures if the company has the ability to pay its long-term obligations. So those ratios included here are debt ratio, debt equity ratio, and times interest earned. So when computing for debt ratio, this is the formula: total liabilities over total assets. What percentage of your total assets is financed by creditors? Then debt equity ratio naman, the formula is total liabilities over stockholders' equity, and times interest earned, net income before tax, or it's also known as operating income. Okay, it means to say before you deduct your interest and taxes divided by the interest expenses of your long-term obligations. So it measures the ability of the company to pay its contractual payments. So there are numerous ratios under profitability ratios. As you notice, the denominator for gross profit margin, operating profit margin, and net profit margin is your net sales. You would like to know what is the percentage of your gross profit in relation to your sales. What is the relationship or percentage of your operating profit in relation to your sales? How big or how small is your net profit in comparison to your net sales? Next, earnings per share. The formula is net income minus preferred dividends, if any, if there are preferred dividends, and divided by the common shares outstanding. As we all know, the preferred shareholders are preferred priority when it comes to giving out dividends. So sila muna yung unang babayaran. So yung net income minus preferred dividends for the preferred shareholders, yung matitira, or also known as net income available for common shareholders, yun ngayon ang paghahati-hatian ng mga common shareholders. Return on assets, net income divided by total assets, and return on equity, your net income divided by your total stockholders' equity. Now, market ratios relate the firm's market value as measured by its current market price to certain accounting values. We have market book ratio. So the formula is market price, kung magkano siya nabebenta at nabibili sa market, sa stock market, divided by the book value per share. The book value per share is computed as your total stockholders' equity minus your preferred stock's equity divided by the average common shares outstanding. We also have price earnings ratio, computed as market price divided by your EPS, and of course your dividend yield, dividend per share, divided by your beginning stock price. Now, let's dig into the details of liquidity ratios. So the first one is current ratio. So again, the formula is current assets divided by your current liabilities. So for example, in the balance sheet of Bartlett Company, you can see here that the total current assets of the company is 1,223,000 divided by the current liabilities, which is 620,000. So The result is 1.97 times. So what does it mean? So current ratio measures the ability of the company to pay its current obligations using its current assets. The question is, meron bang kakayahan si Bartlett Company na magbayad ng kanyang mga current obligations gamit ang current assets? We're not talking about total assets. We're merely talking about current assets. Yung current assets ni Bartlett like cash, marketable securities, accounts receivables, and inventories, enough ba to pay all the current liabilities of Bartlett Company amounting to $620,000? As you can see here, the total current assets, they are bigger than your current liabilities. So dyan palang makikita mo, kayang-kayang bayaran ni Bartlett, okay, yung kanyang mga current liabilities gamit yung kanyang current assets by 1.97 times or almost 2 times. So for example, if a company has a current ratio of 2, that means it can pay twice as much as its current liabilities. Okay, so the higher the current ratio, the better, for it indicates a greater degree of liquidity. Normally, 1 is good, okay, at least at par man lang yung current assets mo and current liabilities, and ideally, 2. Okay, so kung ang company ay merong current liability na 1 peso, that means to say, merong 2 pesos na current assets ang isang company. So kayang-kaya niyong bayaran yung kanyang current liabilities. Now, quick ratio or asset test ratio naman, as I mentioned, it deducts inventory. So 1,223,000 minus 289,000, so that's 934,000 divided by your current liabilities of 620,000. So the result is 1.5 times. It provides a better measure of the company's overall liquidity than your current ratio. And same thing with current ratio, the higher the ratio, the better. So kung meron siyang current liability na piso, meron siyang 1 peso and 50 centavos na current assets, hindi kasama doon ang inventory na pambayad ng kanyang current obligations. Okay, now, inventory turnover, the formula is cost of goods sold. I mentioned, kung anong hinahanap sa turnover, yun ang magiging denominator mo. So, how much is cost of goods sold? Saan natin titingnan? Doon sa income statement. Okay, yung inventory nanggagaling sa cost of goods sold. That's 2,088,000 divided by the inventory under your current assets, 289,000. So, 7.2 times in a year nare-replenish yung inventory. Is it a good sign or a bad sign? Is it good for a company to have 7.2 times? So, for one, it's very important that you ask what the nature of the business is. Gaano kabilis or kabagal nako-convert yung mga inventories into sales and eventually into cash. And to better understand the speed, one way to measure it is through average age of inventory. Dito mo naman nalalaman how many days it takes for a company to convert its inventory into cash. So the average age of inventory is computed as 365 days divided by your inventory turnover. So kanina, na-compute natin yung inventory turnover as 7.2 times. So 365 days divided by 7.2. So the result is 50.7 days. What does it mean? It takes 50.7 days or almost 51 days for a company to convert its inventory into cash. Bali, 51 days ang ginugugol na oras from the time nang bumili ka ng raw materials hanggang sa naging work in progress, hanggang sa naging finished goods, hanggang sa nabenta mo yan at nakolekta yung pera, it takes you 51 days. The question is it good or is it bad? It depends. If it's a perishable item, for example, vegetable, it takes you 51 days, okay, to sell that, to convert that perishable goods, okay, into cash. Is it good or is it bad? It's not good, di ba? Kasi bulok na yung paninda mo, hindi mo pa nababenta. If we talk about equipments, machineries, yung mga tractors, yung mga transportation vehicles, matagal yung pag-manufacture or pag-produce nila, we can say that 51 days is normally short. So, depende dun sa nature of products, goods, or services. Now, receivables turnover naman, we're talking about the speed of your company when it comes to collecting, okay, your receivables. Sales revenue under your income statement is 3,074,000 divided by the accounts receivables of 503,000, so 6.11. To better understand this, let's compute for the average collection period. You would like to know how many days does it take for your company to collect its debts or receivables. Okay, so 365 days divided by receivables turnover, na-compute natin kanina is 6.11 times. So 365 days divided by 6.11 times, it takes 59.7 days for a company to collect its receivables. The question is it good or is it bad? Depende sa credit terms or okay, sa credit policy ng company. If your company is granting 60 days, okay, to your clients, to your customers, okay, so it's good. Within 60 days, nakakakolekta ka na ng iyong mga pautang sa iyong mga customers, right? Pero what if ang ibinigay mo sa kanilang credit terms is 30 days only? So it means to say, 30 days lang yung binigay mo sa kanilang credit terms para magbayad sila ng utang, and yet it takes you almost 60 days to collect. Kulang-kulang 2 buwan bago mo makolekta yung iyong mga pautang. So it's not good because your money is tied up to your receivables. Instead of using your money na in other profitable endeavor, hindi mo ngayon magamit kasi hindi mo pa nakokolekta. So when you have this kind of result, as a financial manager or analyst, nakikita mo na mabagal yung collection ng company nyo and you have to dig deeper, okay, bakit it takes you this long to collect the receivables. So, some of the reasons could be hindi ganun ka-strict yung implementation ng credit policy of the company, okay, or may problem when it comes to approval pa lang ng mga credit terms, hindi na na-check kung gaano ka-credible o ano yung character ng mga customers. Now, let's proceed to payables turnover. It is equal to net purchases over accounts payable. So the assumption here is that purchases is 70% of cost of goods sold. So what is 70% of 2,088,000? That's 1,461,600 divided by 382,000, which is your accounts payable. So the answer is 3.83 times, or it takes 4 times a year to turn over the company's payable. So generally, the higher your payables turnover, the better. Average payment period naman talks about how fast or how slow is your company when it comes to paying its obligations. So the formula is 365 days divided by payables turnover. So 365 days divided by 3.83 times. Ito yung na-compute natin kanina. So the result is 95 days. So what does it mean? It takes you 95 days before you could pay your obligations. So the question is it good or is it bad for the company? Well, again, depende yan sa credit terms or contract nyo ng iyong supplier. Okay, if ang binigay sa yung palugit is 60 days, that means to say, nade-delay ka sa pagbabayad ng utang. So your average payment period measures the number of days that it takes for you, for the company, to pay its obligation. And this payment period is meaningful only in relation to the average credit terms extended to your company. Now, let's proceed to total assets turnover. The formula is sales divided by your total asset. Is your company efficient when it comes to managing its total assets to generate sales for the company? Okay, so the higher a firm's total asset turnover, okay, the more efficiently its assets have been used. So mas mataas itong total asset turnover, mas mabilis. Ibig sabihin, nare-replenish agad yung total assets, nako-convert sila into sales. Now, stability ratio, or also known as debt ratios, ayan. So the formula is total liabilities divided by total assets is 45.7%. What does it mean? 45%, okay, or almost 46% of your total assets is financed by your creditors, nanggaling sa utang. So that means to say, kahit hindi ka na mag-compute ng equity ratio, makikita mo dyan na more than 50% of your total assets ay contributed by the owners or galing dun sa equity. So the higher this ratio, the greater the amount of other people's money being used to generate profits, or also known as leveraging. Now next, debt equity ratio, the formula is total liabilities. Okay, kung kanina sa debt ratio, your denominator is your total assets. So debt equity, so numerator is debt, total liabilities, and your denominator is your equity or your stockholders' equity. So how much is your total liabilities? It's 1,643,000 divided by stockholders' equity of 1,954,000. Okay, so that's 84.08%. So what does it mean? It means that creditors, they provide 85 cents for every 1 peso provided by shareholders. It measures a company's financial leverage. And this ratio should be used to compare companies within the same industry. So definitely, yung debt equity ratio nyo would depend on the industry where company belongs to. So may mga industry na mataas ang kanilang debt equity ratio, normal sa kanila yung 84.08%. So a higher DE ratio is often associated with high risk. Okay, syempre, pag mas malaki yung liabilities kesa sa equity, that means to say, mas malaki yung pera na ipinapasok ng mga creditors sa company instead of doon sa mismong equity or from the owners. Okay, so for a conservative investor with low risk tolerance, mas bagay sa kanya yung mga companies na merong debt equity ratio of less than 1. Let's proceed to times interest earned ratio. The formula is earnings before interest and taxes, also known as your operating income. Okay, EBIT or operating income divided by your interest expense. Okay, as you can see here, the operating profits of Bartlett Company is 418,000 and the interest expense is 93,000. So that means to say Bartlett Company can pay its interest expenses 4.5 times using its operating profit. Kaya ba magbayad ni Bartlett Company ng interest expense gamit ang operating profit? Definitely yes. In fact, for every 1 peso of interest expense, meron siyang 4 pesos and 50 centavos na pambayad ng interest. So the higher your times interest earned ratio, the better. Now, profitability ratios. Gross profit margin. Your denominator would be total sales revenue. So gross profit is 986,000. Okay? Divided by 3,074,000. So you would like to know how profitable the company is after it deducts cost of goods sold from its sales revenue. So pumapatak 32.1% is the gross profit margin. So kada benta mo na 100 pesos, ibawas mo yung cost of goods sold or puhunan mo, meron matitira sa yung 32 pesos and 10 centavos. That means to say, yung cost of goods sold mo or puhunan mo is 67 pesos and 90 centavos. Tama? So 100 pesos minus 67 pesos and 90 centavos is equal to 32 pesos and 10 centavos. So the higher your gross profit margin, the better. Now, let's proceed to operating profit margin. Kung kanina, ang ibinawas pa lang natin ay puhunan, when computing for the operating profit margin, hindi lang yung puhunan yung ibabawas natin, kundi pati yung mga operating expenses. So 418,000 divided by your net sales revenue, so that's 13.6%. Okay? So alin na mas mataas, gross profit margin or operating profit margin? Definitely yung gross profit margin kasi ang binawas pa lang doon puhunan. Pero once you deduct na, aside the puhunan, you also deduct the OPEX, mas liliit na ngayon yung operating profit margin mo. A higher operating profit margin is preferred. Now, net profit margin is equal to net profit over total sales revenue. So 221,000 is the net income after you have deducted all the cost of goods sold, operating expenses, interest expenses, and taxes, and even preferred shares dividends. Okay, so 221,000 divided by the sales revenue of 3,074,000. So we now get 7.2%. So for every 100 peso sales, so pag binawas mo na lahat ng deductions like puhunan, OPEX, interest expenses, income taxes, preferred dividends, may matitira sa yung 7 pesos and 20 centavos. Alright? Or 7.2%. So the higher the net profit margin is, the better. Is 7.2% good for the company? Well, generally, it's good. Positive yung 7.2%. But again, you have to compare it. Kailangan may basis ka. Where are you going to compare it? What if over the past 5 years, nag-range lang sa 1 to 2% yung net profit margin mo? So you can say na this year, mataas yung net profit margin mo. So ideally, look for a company with a growth of at least 7%, with no more than 2 years of declining earnings of 5% during the past 10 years. Okay? Now, earnings per share naman, we talk about the net income minus preferred dividends, or also known as EACS or AX, earnings available for common shareholders. Yung net income, okay, na natira after ibawas mo yung dividends for the preferred shareholders, i-divide mo ngayon doon sa total number of common shares na pag-aari ng mga common stockholder. Alright, so 221,000, this is the net income after madeduct yung preferred dividends, divided by the total number of shares owned by common shareholders, we get an earnings per share of $2.90. That means to say, for every share of stock that you own in the company, okay, it's earning $2.90. Okay ba yun? A higher EPS, okay, is indicative that investors will pay more for a company with higher profits. So the higher the EPS, the better. So when choosing stocks, if you're interested in investing in a company, always choose stocks with high earnings per share. So return on assets is equal to earnings available for common shareholders, also known as your net income after you deduct your preferred dividends, divided by the total assets. Kung kanina sa earnings per share, it's divided by the total common shares outstanding. Sa pag-compute ng return on assets, lahat ng return, ayan, so divided by your total assets. So 221,000 divided by 3,597,000, which return on assets is 6.1%. So it measures the overall effectiveness of management in generating income using its available assets. Choose a company with a higher ROA. Now, return on common equity is your earnings available for common shareholders divided by the common stock equity. Okay, it measures the return earned on common stockholders' investment in the firm. So the formula is yan. So 221,000 is your net income after deducting preferred dividends divided by your common stock equity. So you look at the stockholders' equity. If there are accounts like preferred stocks, ibawas mo yan sa total stockholders' equity because we would like to know how much lang yung ownership ayan, of the common shareholders. So common stock paid in capital and retained earnings. So that's 191,000 plus 420,000 plus 1,135,000 for a total of 1,754,000. So the ROE is 12.6%. It measures the return earned on common shareholders' investment in the company. Now let's proceed to market ratio. Okay, kung kanina yung earnings per share, it talks about magkano kinikita sa bawat shares of stocks na pagmamay-ari mo, that's earnings per share. Ito namang price earnings per share, gaano naman kamahal or kamura yung stocks na binibili mo. Okay, so PE ratio is equal to market price per share divided by the earnings per share. Kanina we computed the earnings per share, which is $2.90. What if the market price of that stocks is $32.25, meaning to say, yung buying and selling price niya in the stock market or in the market is $32.25. So that means to say 11.1 times. For every peso that you earn, you are actually paying 11 peso and 10 centavos. That's how expensive it is to buy that stock. So the higher your PER, the more expensive the stock is. A low PE ratio could indicate that, stagnant company's growth, that the company is burdened with excessive debt, and that the stock could be undervalued, and people are hesitant not to invest in this type of company. But a company with a high PE ratio could be overpriced, meaning mataas yung perceived value, people would like to own or buy shares of stocks of that company. It could have dependable future earnings growth brought on by recent expansion or acquisition, your product line, making it a good choice for growth investors. Now, price earnings growth naman, what we compare here is what we computed a while ago, which is your PE ratio, which measures how expensive or how affordable the shares of stocks are. and of course, the EPS growth rate. So for example, for 2011 and 2012, the earnings per share is $1.81 and $2.90 respectively. So that's a growth of 60%, right? So 11.1 times PE ratio divided by 0.6, that means to say 0.18 is the price earnings growth ratio. It determines a stock's value while considering the company's earnings growth. And a PEG ratio of more than 1 could imply that a stock is too expensive. Okay, when we talk about book value, we refer to common stock equity. So your stockholders' equity minus the preferred stocks over the number of common shares outstanding. So your common stock equity is 1,754,000 divided by 76,262 shares or $23 book value. Book value is also known as intrinsic value. Diba? Magkano pa talaga ang value ng stocks ng company? It's $23. Pero, i-compare mo yan sa market value. Kung nabibili yan ng $32, that means to say, people are willing to pay $32 in exchange for a $23 common shares. Tama? So, book value is used to find high-growth companies that are undervalued. So, the higher the book value, the better. Anong gusto mo? Magbabayad ka ng mas mahal? Magbabayad ka ng 50 pesos kapalit $23 na book value? Or maglalabas ka ng 20 pesos pero ang kapalit is $23. Di ba gusto natin mas maliit yung perang nilalabas natin kumpara dun sa nakukuha natin. Tama? Now, market book ratio naman. Okay? So, market book. So, your numerator is the market value and the denominator is your book value. Okay? So, the market price per share of common stock divided by the book value per share of common stock. So people are buying this stock at $32.25 in exchange for $23. So this is 1.40 times. Okay, it indicates that investors are currently paying 1.40 times for each dollar of book value of the company stock. In peso, it's as if you are paying 1 peso and 40 centavos and in exchange for a 1 peso book value of the company's stocks. Okay? Warren Buffett believes that we have to look for undervalued stocks. Pag sinabing undervalued stocks, hindi masyadong mataas yung market value ng company. Kumbaga, ano bang mas gusto mo? Magbabayad ka ng $20, ang makukuha mo ay $23 book value. Ito talaga yung worth ng company. Or maglalabas ka ng $32.25, ang kapalit naman na makukuha mo is $23. Now, dividend yield ratio naman is equal to dividend per share divided by the market price. So, the dividend per share is already given. So, it's $1.29. So, divided by the market price, given na rin kanina. So, that's 4%. So, a higher figure signals that the company is doing well, and it could signify a long-term investment as companies' dividend policies are generally fixed in the long run. Now, next, dividend payout naman, from the total earnings per share, which is $2.90, ilan dito ang na-distribute na sa mga shareholders or dividends per share. So, it measures the percentage of earnings given out as dividends. There are two things that a company can do with its retained earnings. Pwede niyang gamitin yung retained earnings to distribute dividends or restricted earnings and retain that earnings for other objectives of the company like expansion, to buy another business or to reinvest in the business or to take a more profitable activity. So that's it. That's the end of my presentation. I hope you learned a lot from financial ratio analysis.